Yeah, I mean, you don't have to worry about that. Recording now. So this is like a little intro music. Cool. Welcome, guys. This is Leon Gabon with ProfitMakers.tv, and we are doing an options basics uh, Zoom call meetup today. And let me share my screen. So yeah, basically we're going to go over introductions, which I think I just did. I was hoping Mitt would be here so I can introduce him too. But yeah, I'm Leon. I've been trading crypto for years. Got into options trading January 1st of last year. And now it's kind of like another huge passion of mine in addition to crypto. So we're going to cover what are options. We're going to check out a website called the Options Calculator website and how that's useful and kind of like determining price. And we're going to check out a couple of platforms. Robinhood is the easiest for people to use and get into right away. It's very easy for buying and selling very easy for buying calls or buying puts, but it's kind of hard for selling puts and the more advanced kind of stuff. And then we're going to look at Tastyworks, which is a more advanced platform for options trading. And then we're going to show an example of a buy side trade and example of us of sell side trades. And really, the magic is in the sell side. There's so many crazy strategies on the sell side. There's verticals, there are spreads, there are iron condors, and jade lizards and stuff like that. And then I want to cover the last strategy, which is something and we're trying to teach people about here, which is like the wheel. And this is kind of like a passive income type strategy with options trading. So yeah, what are options? So options are basically they're contracts. So they're derivatives, right? So stocks are the actual assets, and a call option is a contract to buy shares at a later date for a certain price, and puts are a contract to sell shares at a certain price at a certain date. Um, Here is the infographic, which most people use, but it might be kind of weird for some. But look at the x-axis, which is this flat horizontal line. So going from left to right, you have the price. So 95, 100, $105. Then you have this vertical axis up and down. And going down past the zero line, which would be how much you lose, and then anything above that obviously would be a positive. And then the blue arrow represents kind of like the value of your option. In this scenario, it's a call option. So if the price starts going up here, you can see that the arrow kind of goes up towards the profit zone. And maybe this is a strike at $100 or something like that. But if it stays below 95 and below 100, basically you lose. Let's say you bought this contract for $200. And this is the day of expiry, meaning this is when your contract expires. Let's say the strike is $100. And it's below $100, you lose that $200. But if it's 105, 110, $120, you make money on that long call option. And usually the returns are much more than the returns on if you're just holding shares. That's why some people like the leverage that comes with options. And I'll explain that in a little bit. So when you buy a put option, it's the complete opposite, right? You're making a bet the stock is going to go down. So another way you can do that in stocks is you can just short the shares, right? Now there's unlimited risks with on if you short shares, because if you take a short position and all of a sudden a stock moons that keeps going up, you still when you short, you borrow shares and you sell it on the market. Now you still owe those shares. So at some point, you're going to have to buy back those shares and pay back, the exchange or broker. Now, this is good if the price is $100 and then it goes down to 90. You just have to buy it back at 90, but you sold it 100, so you get to keep that $10 difference. But if the stock goes to $200 for some reason, you still have to buy back those shares, but now you have to buy as twice as much as what you yeah. So that's how you can lose a lot of money shorting if you don't close that short soon enough. With a put option though, so you get the benefits of taking a short position on the stock, but your maximal loss is capped because you only lose what you paid for that put option. So like if the contract if the stock is $100 and it drops down to 80 or 70 by the time this contract expires, you make money. But if the stock goes $125 on expiry, you just lose what you paid for that put option. But you can close these trades out early. Like I said, there's different expiry dates, and we'll look at those in a second too. But you don't have to wait till it expires. You can always close the position early. So that could be, you could close the position with a gain early. You don't have to wait for maximum gain. Or if you're taking a loss and you see that the trade's going in the other direction, you can close it at a small loss and you don't have to lose all your money. So I'm going to pause right there real quick. And any questions on this part so far?
I had a question about the length of the contracts. Like, how
Yeah.
long is the average contract?
Oh, yeah. So that's a great question. So there are contracts that end in a week. And if you buy that weekly contract like 2 days before it expires, that's basically a 2-day contract, which is very risky. But there are contracts that go out several years, and those are called leap contracts. And then you have everything in between. So you have got weeklies, you've got monthlies. Um, yeah, and usually the monthlies are like kind of like in the middle of the month, the 16th, 17th, 19th, something like that. So if you are buying a call or buying a put, you want time on your side, right? So if you buy a leap contract, and that's pretty safe. If you buy something with a shorter time frame, that's a little bit more risky because you need the price of the stock to go in your direction with some strength or volatility in the short term. And the reason why those short term things are more risky is because of something called theta, but we're not going to cover the Greeks today. So let's see. That's So that's that and that. Oh yeah. So that's buy side. So I covered buying a call, buying a put. There's also the sell side. So you can take the other side of a trade. So for example, here I'll just go straight into Tastyworks. So this is Coinbase. This is June 16th. So that's about sorry, this is June 25th. So this is 16 days away. So if I click here, so I'm buying this contract that expires in 16 days. So I need the price to be higher than $225 in 16 days. Actually, it needs to be greater than $235 because of what I paid for this contract. But yeah, I've got infinite gain, right? Because this is a buy call, and the price could, for some reason, could go to $500 in 2 weeks. That's unlikely, but the value of this contract will go up a lot. But then I'm only paying $1,050 for this contract. Now, if I'm selling, you can also sell this contract. So here's a 240. So here, I could sell this contract and I get $460 for this contract, as long as Coinbase stays less than $244 in 16 days. It says infinite loss here, but that's because this is a naked sell call. So ignore that for now. Most people that sell calls, they sell covered calls, meaning you own 100 shares and you can sell a covered call. So in that scenario, the worst case that can happen is, okay, the price goes to $250, and you have to sell your shares. But in this scenario, let's say you bought your shares for less than $250. So not only do you get paid $460 in 16 days, but here, let me put my calculator over here. 100 shares. So you get to sell your shares at 250 $25,000. So maybe you bought your shares at $24,000 or $20,000. So you get paid with the premium for selling that contract, and you have to sell your shares, but you're selling it for a higher price than you bought them. So that's why that's an example of why selling options is there's less risk in it, and but less gain, right? Like if this stays below 244, I collect $460. But if I was to buy this guy, and all of a sudden this goes up, let's say $10, right? So it goes up $10 to 235. So what would that be, right? Well, let's look at this. So let's say I bought this for $10.50. Now, each option represents 100 shares. So you have to multiply this by 100. So 1050 times 100. So I paid $1,050 for this contract. Now, if this goes $10 in above my strike price, right? So let's pretend it's 215. You can see that this contract is worth $6 more than this contract, right? So what would that profit be? That would be 16.70 minus 10.50 is 6.2 times 100. So that's a $620 if this thing goes $10 in the money, roughly, because the Greeks can change and stuff like that. So that is buy side and sell side.
Hey, Mia, quick question.
Yeah.
On the sell side, if you can go back to Tastyworks, um, you said if you sell a call and if it's below the strike by expiration, you have to sell the shares.
Yes.
Is the selling of the shares would only happen on the last day of the expiration, or any time the stock goes below that, you will
No,
be
you
forced
can.
to sell.
Yeah, it's only on day of expiry. So
Okay, okay,
yeah, usually brokers will send you a message saying, "Hey, you have a contract, a sell side contract that's expiring today," and just to like, hey, take a look at it, right? So yeah, what he's saying is, I'm selling this 240 contract. The price is 224. This is the day of expiry, meaning okay, cool. I get to collect this $500 and nothing happens. But if this is my contract and I'm in the money, I sold it for 220. Um, like I have my shares. This is a covered call. I have to let my shares go to the buyer of this contract. So if I click here, see I'm a buyer. So I bought this contract for $1,200, and I get to pay. If I'm the buyer, and this is in the money. I get to buy 100 shares for $220, even though the price is higher than $220. That's why that's another reason why people like trading or buying contracts. So there are a lot of people do buy contracts in order to own the shares, or they sell puts in order to own the shares. But mostly what we teach here at Profit Makers is basically we sell the contracts between each other, right? So we never wait if we're on the buy side, and even if we're on the sell side, we sell the contracts once we make a profit to someone else. Yeah, there are rare occasions where it's like, okay, I'll just let this expire worthless, and I'll get to collect the premium, and I get to collect 100% of my profit. If you're on the buy side though, and here's the thing: if you buy a call contract and you're in the money, like you're making money on it, and you don't want to buy the shares because if I buy one contract of this, that's $22,000 that I would have to pay. That I would have to pay in order to own the shares. So that's why most people we trade with don't trade it till the end of the expiry date.
Hey, Leon, I got a question. Could you go over that same scenario, but maybe do Ford that's, F ticker, that's something that's a little bit, more a lesser stock price, so we can kind of see like what that payout would be?
Yeah. So exactly, yeah. Also, the value of options depends on the price, right? So this is Ford. It's a $15 stock. So as we can see here, the prices of these options are a lot cheaper, right? So this is Ford. This is June 25th. This is 5th. This is a weekly. Actually, let's go to monthly. Actually, let's go to July. By the way, if you see W here, that means weekly. Monthlies are usually what I trade. So this is 37 days out. And let's say I'm bullish on Ford. Well, so here it's $15 right now, and I think it's going to get to $20 in 37 days. I could buy this contract. It's only $15 because this is 15 cents. So 15 times 100 and $15. So then I can buy like 10 of these contracts, and it's only $150. And the same thing if you're selling a put. So I'm selling a put at 14, meaning like the price is $15.48 right now, and I want to collect. Okay, well, this is not worth doing it for just 28. So let's do 50 contracts. So here, okay, let's pretend I have the money to buy like what's that? Yeah, 5,000 shares of Ford. That's $68,000. So I get to buy it cheaper. I get to buy it below $15. Or if the price of Ford stays at $15, I get to collect $1,350 in about a month's time. But yeah. So that is.
Hey, Leon, does the price by the expiration, does it have to exceed your strike, or it just needs to move toward that?
In order for what? You don't want to buy
Like
call?
to make, yeah, if you buy a call and if you just want to, you're happy with 50-60% profit.
Yeah.
For example, you have for, let's say you have $20 strike for whichever, right? Monthly. Does it have to be over 20 before expiration, or it just needs to move in that direction for you to get some profit?
No, it just has to move in that direction, but it has to move in that direction. So see, this is only 37 days out, right? There's a very short period of time. So it needs to move in that direction with volatility. Means, it needs to do something like this, right? It can't do something like this and then get to $20. So you need to do something like this. And if you're on a buy call, like if you don't want to own the shares, you need to sell it before this contract expires. Now, if I go all the way out to January 2022 and I buy this call, see, I've got a lot more time. So it's like I don't need the price to like immediately do this. Since it's 6 months away, I can wait for it to do something more like that. And I can make money on this. That's why you're safer if you're doing buy strategies longer term, and you take more risk shorter term on the buy side. On the sell side is the opposite, right? On the sell side, you get less money, but if you sell something that's real, like like a month away. So let's go to July again, and I'm selling a put at 10. Oh yeah, this is nothing. Well, if I sell like 10 of these, that's $270. But if I was like you don't get that much money short term, but you have lower risk depending on where you sell. Longer term out, see, if I was to sell this 14, see, I get more money for it. It's $1.43, but I would have to wait a lot longer time, and the buyer has a higher probability of hitting that if for some reason Ford is bearish like all year. Okay, so any other questions before I go to the options calculator website? All right, so this is a cool site. So here you put in your symbol. So I'm putting the price of coin, and I'm going to select the January contract here, and the price is 224. So I'm going to sell let's do the 300, and let's say I bought I'll just keep it at one contract, right? So now this area here, this is a stock price range, and I want to put the maximum I think it can get to, and the minimum I think it can get to. You can put whatever you want in here. So for this one contract, I paid $1,990 for it. So in here, so it's got every date, and it's got all this price range. So if I go all the way to expiry, if it's $1,200 by January, this will be $88,000 because these contracts will be worth, it'll be worth $900 a contract. So 900 times 100, that's $90,000 minus my initial investment. That's 88,000, right? Now, if I go all the way down here, if it's $300, obviously I lose the money, and I don't make like here. I make some money if it's $330 by January, but I lose money actually because I lose $900. And then if it's $360 by January, I make a profit of $4,000 here. And of course, now let's say it gets to $600 in August, right? So here I could click on that date, and if it's $600 by August, the price of the contract will be $303. So $300,000 minus $1,990. So the sooner the price of the stock gets to my strike price and surpasses it, because this is a $300 strike price, right? And me saying it's 600, that shows like how early and how fast this thing moved in the right direction. That's why you're making a lot more money here. And you see, as you go lesser in time, the profit goes down. And let's go to 420, right? So here, see, if it's 420 by June, I make $12,000. If it's 420 by January, I'm still making $10,000 on my initial investment of $2,000. And so 220, $224. Let's do this calculator. So 224 to 420. That's an 87% gain in the next 6 months. And in sideways markets, that's a big ask, right? That's a big ask for an asset or a stock to reach that. But in this kind of market, with the Fed printing a ton of money, money goes into assets that hold value, and the dollar gets weaker. So it's much easier for stocks to get crazy gains. But yeah, so this is a optionsprofitcalculator.com.
So the numbers here represent the percent gain?
No, this is the this is, you click on it, it just shows you how much. Yeah, it does show you how much you make, and yes, yes, yes. So if I hover over it, that's a 1,500% gain on initial investment. See, this would be 200% gain. This would be 50% gain. So actually, I lost money there. Obviously, 200% gain. So you bought the contract for $2,000. Now it's $4,000. So that's double your money right here, right here. If it's 360 by January, when this contract expires. So this is a great way to kind of plan out, or just kind of like project. If you got a good thesis on the stock, and you can also do this with call. There's long calls, and there's long puts, and then there's all these other crazy strategies we can do. But that's the calculator. And so yeah, we covered tasty. Well, let's go to Robinhood first. So here's Robinhood. I'm sure everyone is familiar with this app. Most people use the mobile app instead of the web app. But here I can buy shares. I can also go to trade options. So here, it's easy to go change the date to July 16th, or let's go August. Okay, so the strike price is 225, and I'm bullish on Coinbase. This contract is 230, and this costs $21.90 or $2,000.90. If I click on it, you can show me some information like bid and ask. It shows me the volume and open interest. Open interest is when a contract exchanges hands. That represents open interest. And this is pretty low. I normally I like something that's like at least 500 or 600 is better if it's in the thousands. So let me go to January here. So a lot of people are out here, 340. See, there's 2,000 open interests, and there are two buys of this contract. This contract today. So there's a lot of open interest here, which is something that's important when you're choosing an option, because you want to be able to get in and get out easy without a big spread. So if you have a lot of people in here, you get a better spread. And by spread, I mean a better distance between the bid and ask price. And this is still pretty wide, but yeah.
So difference between volume and open interest. Open interest is like, I just placed an order, right? It may have not gone through.
Oh yeah, no, open interest is you bought this call, right? Or you sold this call.
Oh, okay. It's a filled order.
Yeah, and volume represents how many trades happen today. So only 2 happen today.
Okay.
Yeah. And implied. Yeah, I'm not going to cover this stuff today. This is for a different class. But yeah, so it's easy to do, but to buy a call and sell a put. I'm sorry, buy a call, buy a put on Robinhood. But to do something like a more advanced strategy, right? It's a little bit harder, right? Because here, like if I was to do something like a spread, so actually here, that's the wrong one. I want to sell a put spread. So I'm going to sell the 210, but I want to buy the 200 as insurance. So see, I've got a custom. This is called a put spread strategy, and it's 2 option contracts tied together to make this kind of strategy. So that's kind of hard to do because you have to kind of flip these buttons and stuff like that. So let me show you that on Tastyworks, and this is what a lot of professionals use: Tastyworks or TradeStation. So here's Ford. So I'll stick with Ford. And let's say I'm bullish on Ford. So if I'm bullish on Ford, you could just sell a put and you get paid $28. But if it falls below, that strike, you have to buy 100 shares of Ford. Now, if you don't want to buy 100 shares of Ford, you could do something like this. So you're selling this contract at 14 and you're buying insurance at 13. So what happens is if the price of Ford, goes to $12, yes, you lose money on the sell, but you cap your losses with this buy put, because the buy put will make money and they kind of cancel each other out a little bit. So here, my maximum loss is $84 because of this complex trade, and I get to make $16 if the price stays above $14, or yeah, basically. So this is a put spread. If I was to do it on this side, this is a call spread, and you do that if you're bearish, if you think the price is going to stay sideways or go down. So $8, low price, $2 at the bottom is the high price. This is called an iron condor. So as long as the price stays between 14 and 17, you get to make $29 while risking $71. So that is 29. So that's a 40% gain on your initial investment. So that's pretty good, but that's because I'm pretty close, right? Like in 37 days, the price of Ford could easily go to 19 or go down to 12. Yeah, somebody had a question. Zoom.
Yeah, it's Kerry. Question on, so sell to open.
Yep.
And just as an example, Tesla. So
Okay.
you sell to open a single contract with a strike price of, because it's at 598 right now, of 700 as a put.
As a put.
How does that work?
Yeah, you don't want to sell a put that's already in the money. You want to sell a put that's below the money.
Okay.
Yeah. Some people might sell a put that's in the money because they just want to own the shares and collect a little bit of premium. But
yeah, reason why I bring that up is if you had it, like if you were to sell a contract as a put at 700, the profit on that is like 10,000.
Yeah, but
you see the confusion I'm having?
It's like that scenario. Yeah, because you that's a valuable contract because the person who's buying that put, right? He gets to sell that for okay. Let's go here. Let's go to 700. Yeah, if the price of Tesla winds up being less than 5. Oh yeah, if it stays below 600,
we both make money, right?
Yeah.
So I would sell it at. So if I'm putting in a put option to sell at 700, am I actually selling at 600 or am I selling at 700? Because the 700 at that point it's spread across with the contract price, right? So it's like I'm getting it at 700.
Yeah. That's why it takes it out of that.
Cool.
Yep. Yeah, that's a cool. See, I've never thought of selling a put above the money, but yeah,
I like to think differently. Sorry, man.
No. Yeah, that's interesting, and that's something I wish I could ask Mitt about if he was on.
And I'm looking at it, and I see 2 bids at 100 and 2 asks at 102.
Oh, let's look at the volume on this, right? So let's go to, and for some reason, Tastyworks doesn't give me a good volume indicator. So trade options. Wait, what date was this? Oh, I chose June 25th. So June 25th.
There's a bunch of contracts for June 18th.
Yeah. So let's go to $700.
Hey, sorry, just to kind of understand what the question is. So he's asking you, we would do sell put at 700 and the right now price is 597. So basically it's in the money by 102. Isn't that pretty much the premium that you see on the contract?
Yeah.
The premium is $10,000.
Yeah,
Right,
so they would be
so-
paying me
Yeah.
10,000 for the contract.
Yeah.
And the only way I don't make money is if it goes above 700.
No.
Not
So-
about, below. It's already in the money, right? So that means if
Well-
you're selling, the opposite guy, meaning the guy who's buying, he can actually sell Tesla to you at $700 right now if he wants to exercise it on the maturity date. So that means you get
That's the question. Yeah, that's the question I had because he gets the right to sell it at $700. Mitt, you're
Right.
here. Welcome.
Yes. Sorry about that. I'm traveling, so just got back to the hotel room. So let me explain it in layman's terms for you. When you sell a put at 700, that means you will be, by expiry date, you will be forced to buy 100 shares of Tesla at $700 per share. It's trading at $598, so you have $102 difference on
So-
Tesla. So that means that you're collecting $102 in premium today
Uh-huh.
in advance to cover the differential. So when you're selling a put that far in the money is not advisable at all, because when you do that, you're pretty much not making any extrinsic value there. And extrinsic value means that there's some premium that you should keep that is not directional premium. Now, what is directional premium? Is that right now it's 598. It has to go to 700 before you make even any money, extra money on top of the premium, right? So you will just make money on it if Tesla goes to $700.
Well, but it's a covered put. So I'd be putting the options contract in for a put on 100 of my shares.
It is
Right.
No. So that's a covered put is different. Okay, a covered put, you have negative, you're shorting the stock and then you're selling a put on top of it. A covered put is a different strategy altogether. So that means you do not own shares, you have short negative shares.
Okay.
So the covered put is not that. A covered call is
Covered
when-
call means I have the shares to sell
correct.
the option of a contract on.
Yes, covered call is when you have the actual shares. A covered put, you don't own the shares, you have a short interest in the shares. You have negative shares.
Okay. So how does it factor in if I do have the shares already?
If you have the shares already, you shouldn't be selling a put at all. You should be making a decision that, okay, so let's say you have shares that valued at X price. What is a good level you want to sell those shares at? What is your profit target, right? That is the analysis you have to do. And then keep selling calls against the shares so that you keep collecting income consistently on it. And if it crosses that, you keep rolling the calls further out.
Yeah, so let's get into the sell side strategies now, right? So, did that answer your question, by the way, Kerry?
Sort of.
Okay, yeah. So everyone gets buy side, right? You buy call, it gets in the money, you make a lot of money. You can make 3 times your money. Like if the share goes up, 10, 20%, you just get 20% on those shares, but you can multiply your profit on the buy side. You can also lose everything on the buy side. On the sell side, so here is Roblox, and this is what I did. Oh, I
Did it go
missed.
down, or it's where is
Up,
it
dude.
trading?
It hit $100.
Holy shit.
I know. I miss Roblox. But I bought I think 400 shares on Roblox.
Yeah, I bought it $68, I think. I
Yep,
remember.
60. I bought 68.
Yeah.
So I owned the shares, right? And I'm doing what is called conservative sell side strategies, meaning I sell a put that's out of the money, and look at this. I sold a call that was out of the money. And look at that. I look at it. I look at my history, man. I got $2.40 for this 319 call at $100.
Yeah.
Like people were so bullish on Roblox, and just like
Mm.
Coinbase, and we'll get to Coinbase in a bit. Oh man, that's depressing. But so I did this. I sold covered calls. I forget how many, and I sold a put. So this was fine because I had $6,500 ready. If it did drop to 65, it's lower than my cost of 68. So if I did have to buy 100 shares at 65, I mean, that's fine. It brings my, brings me down to 67, 66 or something like that. But I got $81 for this or more if I sold more puts. I can't remember. And I got at least $240 for this by selling one, right? And it opened March 10th, and this expired in 10 days. So in 10 days, at the minimum, I made $300 here. And there was some stuff I sold in April. I didn't go back into the history to find out when I sold those, but I also sold this guy. And so this guy I closed early. So I sold this guy in July of 19, July 19th. At $100, and I remember I closed this guy like somewhere here. I closed it for profit, so I didn't get my maximum profit because if I waited till it closed here, and Roblox did something like this, I would get my 100% profit. But I closed it early, and I still made a profit, right? So if I closed it here, I would get more profit. If I close it here, I'll get less profit.
Yeah, let me, who's a Zoom user? I can help that one scenario out a little bit.
Do you want
Who's
to share?
Zoom user? What's your name?
Oh, that's
Zoom user?
Carrie.
Carrie.
Carrie, hey Carrie, yeah. So let's give Carrie an opportunity with an example with Tesla shares, right? With the sell call side, right? This is going to blow your mind a little bit thinking about it. Now, is it safe to say you have 100 shares of Tesla at least, or no?
Yes.
Okay. So now just think about it. You can do this for every 100 share lots. Okay, I'm just going to give you a scenario. And I'll mimic it to what you have today, right? Like, okay, so how much did you buy Tesla?
Oh, I bought it
shares,
way back
average
before
price.
this, at 243 a share. Long time.
243. Right now, yeah, that's good. So right now it's trading at $598, right?
After the split,
Okay.
yes.
After the split. So maybe I think I guess I don't know what the split price, whatever profit you made. Let's say you made a gazillion profit, whatever you made. Okay.
Yeah.
We're not going to account for that profit. Let's say now you have all that profit and you're happy about the profit, but you're now at a phase where you're like, okay, you know what? I still want to own this, but I want to also harvest money along the way, right?
Yeah.
In that journey, right? Like I want to harvest money. So now we're at 598. Okay. Now let's go like can you show the expiry window, Leon, on here? Yeah, there we go. Perfect. So let's pick now this is, I'm going to tell you all the rules of thumbs that I follow, so that these are tricks and tips that I learned from market makers like Tom Sosnoff. He's actually a market maker. He's the one that invented this platform that we're looking at right now. So I was fortunate to learn from him. So his team has done a lot of data analytics on option contracts to make a conclusion that some of the best contracts to sell premium on are between 30 to 45 day range. Okay. So because that is where the largest decay happens in the contracts is 30 to 45 days out, they start decaying rapidly. Okay. Now, what is decay? That means that the buyer that's holding that contract that is 30 to 40 days out, if the stock price doesn't move like a rocket ship up at all, if it doesn't move like a rocket ship up, it loses value, kind of thing, like crazy. And just a second.
Which date did you want me to pick, by the way? Oh,
I was going to say, let's pick July 16.
so this is 37 days out. While he's on the call, I'm suspecting he's going to say you're going to sell a put if you want to own more. Oh. Sorry, Arya, had to mute you.
Just a second. This was an urgent call.
Yeah. But yeah, we're looking at Tesla. I'll go ahead and talk about my strategy if he's he might have something else planned. But here, let's just jump to the wheel, right? So this is. Oh, are you back, Mitt?
I'm back. I'm
Okay.
sorry about that.
Go ahead.
Just want to make sure family's okay. So just a second. So now, okay. So we're at like $600. So now I think, Carrie, can you tell me, like in a month from now, where do you think you would be comfortable selling your Tesla shares at? $700, $600? Where would you want to sell your shares at? At what price? Are you there? You're on mute if you're talking.
There, sorry about that. I'm expecting probably 680.
680? Okay, so go down to 680. Yeah.
The options contract on that is 770. So
Okay, so let me tell you, we have like analytics here from this tool that tells us that the potential, the potential standard deviation of this contract or the break evens based on the expected moves is at like 648 based on all the bets being placed. Like you cannot exceed $648 based on the option contract bets only. Okay, not the stock price or the stock purchases, but just on options trading. But so if we say 680, right? Can you click on 680 right there? Okay, and sell right there, sell, right?
Yep.
So at 680, 1 month from now, you see there is $13.65. See that? That is $13.65 per contract times 100, which is $1,365 per contract per 100 shares. Okay. Against your shares, if you place this contract, you will not be required additional capital, zero additional capital. And if Tesla doesn't go to 680, it stays below 680, you collect $1,365 in your pocket. Okay. Now
with no obligation to sell at that point, right?
And let me go through all the scenarios that you would experience, okay? So then you would not have to sell it. It will expire worthless, okay, on the expiry date. So you don't have to do anything. You will collect 1,365 in your pocket and you're done, okay? Scenario number 2, okay? Let's say it crossed 680, okay? What happens? You will be forced to sell all your shares at $680 per share on that given day, on that expiry day, and also get to keep $13.65. Make sense?
Yeah.
Which means you're technically selling your shares at 680 plus 13.65, right? Because you're pocketing the 13.65.
It's a smidgen of additional profit.
Yeah, additional profit. Okay. Now, a lot of people will tell me that, Mitt, yeah, well, what if it went to 720 or something later on, right? Then I have lost interest in this, right? I'm not happy with this. The best thing you can do is do this. And then if you feel like you're going to sell it and it's going to go past that, there's something called rolling. Okay. Rolling comes in when you change your mind, Kerry. You're like, okay, it's 680, but now it has gone up so fast, and you're like, I still want to keep my Tesla share. This is scenario number 3. Scenario number 3. Okay, it has gone past 680, and you're like, Mitt, but now I don't want to sell my shares. I want to make more money out of it. So scenario number 3 is you're going to take that loss that you're going to experience at 680. Okay. You're going to take that loss by closing it and purchasing another contract further out 1 month later or 2 months later that makes sure that you cover your loss on that one, plus make an extra profit. It's called kicking the can forward.
Yeah, look at
Or-
this. Yeah, right here. Like I didn't even have to move it that much, right? Let's say
so-
your 680s in jeopardy, right? Now we go out 1 month and we sell at 700. Now we're getting $2,500 for that. And here's the thing, for Tesla to move 30 days like that, like from under 600 to 680, that's a big move. The bulls most likely might be getting gassed out at that point. So you kick the can out of the road, right? You took a loss on 1350, but you're not going to take that full loss. You're going to take some of that loss, and then you sell this, and you get even more money. But yeah,
So it's called kicking the can forward, and it's also called like rolling in the technical world. They call it rolling. And why do we do this? Is because we want to make sure we collect enough premium to make sure we cover the loss on the prior. And then you personally have to make that decision at that point and say, okay, you know what? I pushed the can to 680. Now I'm now pushing the can to 720, and then I'm pushing the can again to 760. Based on my experience, you can roll about four or 5 times, and you can keep doing that, and you're not going to lose a single dime by doing the roll functionality. And then the 4th, 5th time, you may have to give up your shares at probably like $800 or $900, and you'll say, okay, goodbye. I don't want to keep the shares anymore, and you go forward with it.
but you
Now,
made a
here's the-
lot of profit.
But you'd have made a lot of profit on your shares anyway, and you would have collected the income on this side as well. So this is like a dividend kind of strategy, but it's not dividend. It's like you're selling calls to create income in your pocket. Okay. Now, here's the interesting thing: is like, well, Mitt, I want to stay in the game after I rolled 4 or 5 times. Well, if you want to stay in the game again, then just go buy the shares again. And you wouldn't have lost anything because you would have actually bought the shares at the same price they were let go at that given day on the expiry date. So you can close that out and just get back into the game again. Okay.
Looks
Now-
like Vinny has a question. Oh, sorry. Go ahead.
Yeah. So that is the selling side on the call side. And then I'll share a little bit on the put side as well on top of this. So now, do you have questions there, Kerry?
No, I'm good.
Vinny raised his
Yeah,
hand.
Go ahead.
My question is pretty basic. Like,
Yeah.
I think
Yeah,
I
go
kind of
ahead,
get
Vinny.
buy side. I kind of get buy side of the story pretty well. Just trying to understand, like, how would you pick, or I would say, which stock would you pick to do sell strategies?
Okay, so my sell strategies are normally on more stable growth kind of stocks. They're not like moving up so fast, or stocks that I have made a significant amount of money and now I just want to monetize by selling premium against it. Those are the two. So you cannot really say that there is specific stocks that you can do this on. I'll tell you why, for 2 reasons. And this is from historical experience of people talking and all that, is that like for this scenario that we just went through, right? For him, it probably makes sense because he's already made a significant amount of profit before the split. He bought these shares, and now he's like, you know what? I would ideally give up these shares now, but I just want to see how much I can milk it by doing this, right? And then eventually I'll give up the shares if it decides to take off, right? So you can do that to Tesla. But now if you're getting into the position today and trying to do this today, you may not do yourself justice, because you'll be like, okay, you know what? I'm already selling calls against this and I haven't monetized on it yet. So this may not make sense. And then if you're going from day one, like stocks that have been like going sideways are the best ones to go into. If you want to do the covered call strategy from day one itself, you just go to the stocks that are going sideways. And those are the best ones to get into.
Cool,
Right.
cool.
So for example, Apple is not moving recently, so you would say something like that would be a best
Yeah,
bet
look
rather
at the
than
chart. Is
something
it
like
going
AMD, right?
sideways? Is it going sideways, the chart? Look at the chart. There
I
you go.
mean, it's
Yes.
ranging, but it's a big range.
Yeah.
Yeah,
So-
you could say it's been going sideways since May 10th, but it is in a range of this and this. So yeah, it looks right now we're unsure what a direction is going to be, right? So this we're in the channel now. We're getting a little technical analysis, but it's either going to do something like this or eventually something like that or something like that.
Okay.
But right
Nice.
now it's in a it is kind of going sideways for about a month or two.
Yeah, yeah. So yeah, no, that's kind of the way. Now here's I'm going to add a little another sell side strategy to this. You go back to that, like here's the cool thing you can do. Like let's say now I think I'll give Vinny a chance to pick a ticker symbol, like pick a random ticker symbol that you want to own the stock, but you want to build a sell side strategy that gives you income over time. Just give me a random
Yeah.
stock that you like.
Yeah, I think Apple is the one that I was kind of
Apple?
looking
Okay.
at. Yeah.
Yeah. I think Vinny went to the dev conference or saw the dev conference and hasn't seen the stock gone up yet. So it's like
Yeah.
all these new features.
Or I can say, like, given the rates are going to be rising, like
Yeah.
if I was like doing this a year ago, maybe something like JP Morgan or any of the banking sector might
Yeah.
would have
I
made
was on
sense.
the-
But
Yeah, I was on the plane yesterday with the CTO. I'm a CFO of a company, but I was sitting with the CTO, and he was listening to the Apple Dev Conference, and he was like, "Oh, now you're going to be able to load your ID into the Apple platform. You're going to be able to do this feature." I think the Apple 15 or something like that, the version that's coming out, and the stock hasn't taken off yet, so it's a good opportunity to jump in. That's what he was like trying to explain to me. They had a dev conference, this one right here, that went on, I think. So he was listening to the entire dev conference on
Right.
all the features that are coming out in Apple. So, but
So we
yeah,
can-
let's go
if
back
that's-
to the. Yeah,
if
go
that's the
ahead.
comment that you have to get, if it's a good level to get in, then if it's a sell strategy, you can do a sell put in that case, right?
Yeah,
hoping
well,
I'm-
let me explain
Yeah,
sell
sure.
puts a little bit in a nutshell, right? So let's say you're excited to get into a Apple, but you like just remember selling side,
Mhm.
if done right, is a conservative strategy. If done right, okay. If done wrong, is a bad strategy. But if you learn it the right way, it is a good strategy. So now, first and foremost, if you're going to sell a put on this, you have to go with the assumption in your mind that I want to own shares of Apple, right? That's why I'm selling a put.
Mhm.
If the worst thing happens, you'll sell a put to own the shares, which is called assignment. So if you sell a 130 put, okay, 37 days out. And my recommendation, again, don't take this as financial advice, but I like contracts that expire 45 days out because of the theta decay that gives you a lot of money. Okay, like theta decay is very powerful. 45 days out, somewhere between 30 and 45 days out. So this one's a good contract, 37 days out. We can even go further out to 45 days out if you wanted to. But I think this one's a good one. Yeah, we can even do this one too.
Can we do the weekly?
Yeah, we can do the weekly too. That's fine.
All right.
Okay. So now here, you can ideally, if you're bullish on this, Vinny, and you really want to get in it, you sell a put at the money. Okay.
Right.
at the money, which is $128 or $127. Okay.
Mhm.
So how much premium are we collecting there? $425. Okay.
Right. Mhm.
So if you think about it, the way you do the math here is your cost basis is 128 minus $4.25, which is $123.75. So
Mhm.
worst case scenario, on July 23rd, if Apple doesn't move, you will be forced to buy Apple at $123.75. You'll be forced to buy at 128, but just because you're pocketing $425, your technical cost basis is 123.75. Do you agree with that?
Yeah.
Okay.
Makes sense.
So if it stays underneath that, you will be forced to buy shares.
Mhm.
And you're technically paying less than the market price. The market
Mhm.
price is 127, you'll pay 123, which is amazing. As of today, you're like fixing yourself that you're willing to buy it at 123, even though it's trading at 127.
Mm.
Got it?
Yep.
And so you're getting that opportunity. Now, if it goes
Great.
above 128, you make your money, you go ahead and set up another one at the money. And you keep doing this until you get assigned. Okay? And when you get assigned, you start implementing the sell call strategy that I just described on Tesla until
Right.
they take your shares away.
Mhm.
And then you do the same thing on the sell put side. Again, you keep rotating. By doing this strategy, you're going to do yourself better justice than buying the stocks outright and taking on very directional risk there. Here you're at least collecting premium to lower your break-even price of the shares.
So, Mitt, if you don't mind getting, if you want to get assigned, or if you don't mind getting assigned, then it's okay to do weekly, or we should still do 30 to 40 days out, like selling put.
No, weekly, we said, so the contract is weekly, but look, it's 44 days out. Weekly doesn't mean the next week. Weekly just means that it's a weekly contract. We have two kinds of contracts. We have monthly contracts and weekly contracts. So this is a weekly contract because the expiration is off month cycle. That's it. Okay, so if you expand on that, let me show Jeet a little bit what we mean by weekly. Okay. You see there's a W beside the contracts. See that, Jeet?
Mhm.
W stands for weekly contracts, and the ones that don't have W are the monthly contracts.
Yep. I mean, I
Well,
feel
what's
like
the
this is-
difference? Are we looking at the days, or are we looking at monthly, weekly?
No,
Like,
weekly
what's the
means that
difference?
it expires every week on Friday.
Okay.
And then monthly means it expires on the month end period of that. And the month end period is always mid-month.
that's basically the difference.
Okay.
Man, I feel like this is a great segue into the wheel.
Yeah,
Right.
so that's what we were talking is we're building on to the wheel strategy, right?
Yeah. So here again, a profit maker is like we're trying to like steer people into thinking more about the wheel. Now, because it's one of the best passive income generating strategies. So let me get into that. So I'm gonna start with an extreme example. Then I'm going to go into a medium term example, and then we'll look at something that's like a little cheaper. Again, with sell side strategies, is you need a little bit of more money to make the profits worth it. That's why most people with smaller portfolios, they usually start on the buy side. They try to make some good gains, and then the ultimate goal, like all big option traders, are sell side because it's safer and it's more passive income. While everyone's trying to buy a lotto ticket on the buy side. So let's go to Tesla. And 2 weeks, right? Because we want to emulate a paycheck. So my mom has 1,000 shares of Tesla. She just retired, and I'm trying to talk to her into doing this strategy because Her cost basis is really low too. I think pre-split, way low. So it's 598, and we're gonna sell at the money 10 contracts, right? So that's basically oh wait, she's let's normally you start with puts because you have the cash but you don't have the shares. In her scenario, she has the shares but not the put. But yeah. So let's go start here, right? So it's 598, and we're gonna sell the 605. So basically in 2 weeks, she gets to make $22,000 profit. If this stays below 605. Now what happens as soon as it gets to 605? Well, her cost basis is $135 a share, something like that, right? Really low. So boom, she makes the money, right? It goes to 605. Now what do you immediately, as soon as you lose your shares, you come back around, you could sell the 600, right? There's less than the 605 or 697, and then you sell 10 puts. So now you get to buy, you get a paycheck of $24,000 in 2 weeks, or you get to buy back your same position for less money, right? So 605 times, so that's it was this minus. So not only does she get to so she's getting paid $24,000, but she also gets to keep the difference of $32,000 because she's buying back lower at $57,000. So and you keep doing this, right? As she sells the shares, all of a sudden Tesla drops. She comes back immediately, right at the money, and sells these 10 contracts, right? Okay, so now what scenarios can break the wheel? So there's two, right? If for some reason the price rockets, like just takes off straight up, right? Like you lose your shares at 600, that's fine because you just keep selling at the money puts all the way up, right? Like this could be here, it could be here, it could be here, and it could be at 700. Like you just keep selling the puts and you keep getting a paycheck. Who cares about the shares? It's not about the shares, it's about the paycheck. So you keep selling that put at the money. Eventually, Tesla's going to drop a little bit, and you're going to get your shares back. So that's one way. Or you sell your shares, and you don't want to trade Tesla anymore. You just go trade a different stock and come back to Tesla later when it cools down. But I would just ride that put all the way up on that moonshot, right? Now, what's the other scenario? So the other scenario is Tesla, for some reason, crashes from $600, and for some reason it goes to $400. Now that would be the worst case scenario because now you're selling covered calls, but you're not getting as much return over time as the price keeps going down, right? Now this is off because the price would actually be lower than this, but you're selling the covered call and you're getting less premium over time. But you could do that, right? You could do that and just wait for Tesla to come back, turn around bullish. And also, Tesla is not a stock. It's highly unlikely for Tesla to crash like that. That's why most people do this strategy on something boring like the SPY or AT&T or Amazon. But I'm promoting doing this strategy on Tesla, or I would do this because I'm not a financial advisor. I would do this strategy on Tesla because the volatility on Tesla is so high that you get to, you make more money with less money, less capital invested, right? So most people, they do this on SPY and see, look, this is a paycheck. It's $4,300. It's not $20,000, and it requires more capital. But SPY is very boring. It barely moves like 2%, here every now and then, right? So that's an extreme example, right? So let's go to Tesla. Let's go to something that's a little bit more, like, okay, let's sell one, right? So here, you don't need $500,000. You just need $50,000, and you get a paycheck of $2,500 every 2 weeks. If you want to sell two contracts, just double that, 100,000 and 5,000. So that this is a more medium size. If you want to replace your paycheck, this is your medium size strategy. Now you can, doing something like, let's see, Palantir, or let's see, SoFi. See, you can do it on SoFi, and let's try to keep this below. Okay, let's try. Let's say you had $10,000, right? So, in my opinion, this would be a small position wheel, because okay, every 2 weeks you're getting a $900 paycheck. Or a $655 paycheck, right? So, see, that's why you on the sell side you need a little bit more capital in order to make some gains from this strategy. But that's the wheel. Any questions on that from you or Mitt?
So Leon, if you're selling put on for example, you can pick any. If you can go back to Tesla, for example.
Yep.
Yeah, if you do $600 sell put, and like you said, when the wheel breaks, let's say if it shoots down to 400,
Yep.
so obviously then you have to buy at 600, right?
Mhm.
And then the Tesla stock is now at 400. So now you immediately sell call, or you wait for the stock to come back a little bit so you can get more premium?
So hold on, let me clarify there. So if that's a good example, right? So if it goes down to $400, so how much are you technically losing? Let's do the math, right? Is you're technically losing, you've collected, by the way, how much premium? That is $26, right? About, what is it, 26.13, but you get, let's round it to 26 just to be on the safe side. Well, 26, right? So technically, your cost basis is 600 minus 26. Agreed?
Right.
Yeah. So 6 minus 26 is
574, 75, 574, yeah.
574, and then $400, right? So that is 174 times 100, which is $17,400 for a contract. Okay, so that is going to be your realized, like, not unrealized loss. Now, this is where you have to ask yourself, are you going to chicken out of that trade? Are you not going? Are you feeling like everyone's chicken, but you're not a chicken, or we are all like, lions in the trade, or what are the animals with references we can give? So here's where, like, you start building your strategy based on you're basing it on your emotions or non-emotions, whatever, like based on your break-even strategy, right? So now if you have 400 and you feel like now it's going to go sideways, or you've done some technical analysis to identify that it will go sideways, it won't take off, or you feel like it is sitting in the limbo, then you can go ahead and start selling calls immediately at 600. Okay, and you keep doing that until the day it decides to go above 600, and then make adjustments on it. So you will keep earning money on the 600 side while it's at 400. You won't make $25. You will probably make, I would say, let's subtract 400. So yeah, right there. You'll probably make, I would say, no, it can't be that bad. Let me see.
200 above, yeah.
600 plus 400, right? Okay, yeah, you're right. So yeah, you'll make like $45 or $50 for every time you keep doing that at that price. Or you can say that, okay, it's at $400. I'm willing to take a small loss at this point. Then you will just sell a call at, while it's at 400, you can sell a call at 500, which is going to be making you go to 700 contract. See how much a 700 contract is, right? Yeah, you make $240.
So yeah, that's one way to do it. But here's my thoughts on this. So you're on the wheel. We're recommending 2 weeks out, right? So 16 days. that scenario is already a very rare, super unlikely that Tesla's going to drop $200 in 16 days. Now, okay, let's talk about the 1% that happens, right? If you've been making money on the wheel this whole time, it's okay taking a loss. Like you own those shares. You bought the shares at 600, and it's all of a sudden it's 580. Yeah, so you could decide then to if your technicals or there's some kind of crazy fundamentals. Elon Musk died. They're working with the Chinese government to spy on America, like something crazy like that causes Tesla to go to $400. Then yeah, take a loss. Just take a loss on that, and then we were recommending. We're planning a portfolio of like 3 to 5 tickers that you go trade next, right? So now maybe we do flip to Apple. Now maybe we do flip to Coinbase.
Yeah, but let me say one thing, Leon. There, like people are so emotional traders that they'll not give up on it. So that's what I'm saying is that if you want to stay stuck to that trade because of your emotions, you can get yourself out of the hole eventually by keeping on selling calls against it, because when it goes back down to 400, it doesn't stay at 400. It will come back down. You know the market at this point, it bounces, right? There is no stock, like maybe there's probably 1 or 2% of stocks that are in the top tier blue chip stocks that have gone down and never made it up, right? Like the funny part is emotions always tell you that anything that goes down will never come back up. It will keep going down, right? That's what emotions will tell you. So the only dangerous part here that I have a hard time explaining or digesting is people don't have enough capital to do this. And when you do this with very less capital, you're doing yourself injustice, kind of thing. So just be careful there, right? You're trading on margin, you're not trading on capital. So always do the math that if your cost basis is 600 minus this, you're paying that much and it's trading at X price, you're going to lock up that capital for some time there, or you have to move on to something else that's moving.
Yep. By the way, check out the chart. This is what we're talking about. That this is not even a 1% chance. This is a 0.001% chance that Tesla makes a move like this in 16 days. now, okay. So even if it's let's say 500, right? So let's go to 500. What would that be? That would be 500. 500. That's 16% down in 14 in 15 16 days. It's still highly unlikely that happen. Now it happened here. It did happen here, so that's possible, and it did happen here as well. But after and now this gets a little tricky because you kind of have to know a little bit of technicals to kind of like prep you, because we did have this drastic move down. And we had another drastic move down. So it's the likelihood of another drastic move down. I mean, the direction is still bearish at the moment, but another drastic move that large is unlikely. But now we're getting a technical, so maybe I should like leave that for a different Zoom. But yeah, cool. Any other questions on that? That's a good question. So yeah, like bailing out is a strategy, right? But yeah, if you're locked into it, here's another thing. So let's say it does fall out to 400. Let's pretend it was at $800 and it fell down to 600, right? Because 600 is our 400. You can sell covered calls, which are, at your break even, but you don't have to sell your break even. If Tesla's crashing that low, you could sell something that looks like the 620. You could sell that and make 1,600. That's a lot better than 500 or $50 down here. If the price is getting depressed that low for some reason, right? There's some fundamental, some technical reason why it's dropping. Yeah, just sell something that's up here, or like let's go to the.
It's a range of thoughts, in my opinion. It's a range of thoughts. Like, how much risk someone wants to take. So people tend to mentally always create a baseline that I should always recoup my full investment. And that is a very bad thought, right?
Yeah, yeah.
Yeah, that will depress the situation really bad. Okay. You have to think beyond that, okay, now your new value is this. How much do you want to salvage out of this? Or how much do you want to deal with this trade in terms of prospect? If you have high conviction, then you don't depress your trade. Just keep selling premium at your cost basis and live with it, right? For months and years to come until it recovers. It may recover like within weeks, it may recover within a year, we don't know. So it will have its own cycle.
Yeah, that's a good point, man. Yeah, because a lot of people who transition into options traders, they're usually stock long-term holder positions, right? So yes, again, you're not trying to reclaim your original investment. What you're trying to do with options trading most of the time is earn income. So it's this premium, right? You make this premium, and you can roll some of that premium out, and you can add that premium into another trade, or you pull out this $235 into your bank account. So that's what these contracts are for. These contracts are for generating premium. And now your underlying, your shares might lose value, it might go up in value. That's besides the point. The point is making income. But yes, that Tesla going from 600 to 400 in 16 days, that's doomsday scenario. And yeah, and we would I would bail out in that scenario. I would take a loss. And then, wait it out, trade something else. But yeah. Any closing thoughts on that, Mitt? I think we're at a good point. I think we covered everything. Let's see here. Yeah.
Can I just ask one question?
Yeah. Go ahead.
Yeah, just one more question. So I understand how the verticals work. I'm not getting like clear answer when I asked a couple of people, including Zen. I never spoke on the phone though. When you're doing vertical on the put side, but if you have a gap, right? Yeah. For example, there you go. But if you have a gap, let's say you put the buy at 585, let's say.
Okay.
Yeah, 585. Yeah, there you go. What happens if it's at between 586 and 594? Do you ever get assigned in those scenarios?
Yeah, let me explain what happens. In 585, like I think we did this analysis when we did that Saturday call, but we'll do it again, right? What happens to the 585 contract that you bought? It goes worthless, right?
Yeah, the long buy goes worthless.
What happens to the sell one?
You would get a sign on that one, right?
Yeah. There you go. You answered your own
question. So they do work separately.
Yes.
So
yeah.
Because when you click on like review and send.
Yeah, don't ever combine them. Don't ever combine them in your mind.
Yeah.
You see, that is the biggest problem. They think that some magical thing will happen when you buy these positions. The only magical thing that happens is it reduces your capital requirement. Okay, that's all. There's nothing else that's magical about this. It is two separate contracts doing two separate forces, and your buying power is less because the machine knows that if we go below 585, that will start making money. And because the machine knows that, they're not making you hold a lot of money up front. Does that make sense?
Yeah. I was just confused on the message. Like when you click on review and send, I want to read the message. So if the price of Tesla is greater than 590, okay, that's fine. But if the price of Tesla winds up being less than that, your max profit is 560. So obviously here it doesn't talk about getting a sign and all that. It just talks about profit and the loss.
It doesn't. Yeah, this is assuming that if it stays below 560, does it tell you what happens in between? No.
No, there you go. That's
so
the point.
Yeah, this I would say this is a very risky. So the only reason someone would do this strategy is they're going to get 78% gain on investment, right? if I was to put this closer, obviously I would get less, right? So this would be, wait, what?
50%, this would be 100% return. Yeah.
Okay, that's because I'm very close.
Yeah.
I would only do this. Okay, here. Yeah, you would probably want to push this back back a little bit. So there you go. Yeah. If I was doing a put, basically this close to the money, a put spread, you have to be very bullish on this stock. Like this stock needs to be going up because
No, so the best way I can say is that it either has to be very bullish at that level, or it stays way below that level, doesn't stay in between those levels,
you know.
because the max you will lose is 125. Make 125 to lose 125. I'm okay with that. It's a gamble, 50-50 shot.
Yeah, that's like playing war at the casino. That's
Yeah, yeah.
I like that. I
Yeah,
like that
you're
game.
putting your money on the black versus the red, right? Like, okay, you know what? 595. Just pray it stays above 595 in 16 days from now. If it does, there you go. You make 100% return.
Yeah, but I mean, if you're that bullish, just buy a call. Buy a call, then forget 100%. Let's go for 200%. But yeah,
Because-
yeah.
Well, buying a call in that situation, like you're buying and then you lose everything in the call. Here, you'll lose no more than $1,250 if it goes way below 590. It goes below 590.
Yeah, but then the call. Oh yeah. Actually, that's the call will be $2,500. So yeah. That's a bigger risk. Yep. Cool. Well, we're at an hour and a half, people. Thanks for watching. If anyone here is interested in becoming a Profit Makers member, we can help train you guys for free. You can join our Discord. In fact, here, let me post the link to our Discord. So in our Discord, we charge $100 a month, and basically we'll Zoom with you guys one-on-one. And we have a weekly meetup, and we get you all your answers, questions answered, and you can cancel anytime. So here's our Discord link. If you want to join our Discord, you can join it as we've got public channels. You can watch like videos of basic stuff, options, and some public channels. But once you're a paid member, you get access to my trades and access to Mitt's trades. Zen, who's she's a female trader and she does really well, sell side strategies. And we stream in the private channel usually 4 days a week, and we'll stream in the public channel pre-market, like usually 1 day a week. But I guess let me turn on that music. Thanks for watching, guys. Oh, whoops.